Welcome to this episode of the Founders Peak podcast in collaboration with Couchonomics with Arjun. Joining me is someone I actually know fairly well, and I think we get into more discussions than I do with, I would even say, my own wife. Um,
Discussions.
well,
I was going to say, what else?
no, so Ronit, welcome.
Yes.
So Ronit Ghose is from Citi. He'll
Mhm.
obviously introduce himself very shortly. So we've coined this the yellow table.
It does look yellow.
So welcome to the yellow table.
Thank you for having me.
So do you want to do a quick introduction of who you are, Ronit, before we sort of get into the...
Yeah, sure. So my name is Ronit. As you said, Arjun, I run a think tank for Citi called the Future of Finance. My day job or my primary avatar is that I'm an analyst. We've rebranded ourselves from research to think tank. I have multiple other avatars like you, Arjun. I reside in Dubai, in the UAE. Why there? Because 7 years ago when I moved to Dubai, people were like, are you retiring? Now they're asking me, how do I get to Dubai?
Fair
Because
enough.
the reason we moved to Dubai, like Singapore, that was the other option, was I wanted to be where the action was going to be, where the room, the virtual room where it's happening.
Mm.
And what's happening is that technology and other drivers are changing the way we live, changing finance. And I think in what we used to call emerging markets, that's where the biggest, most profound changes are happening. Other avatars, I'm an advisor to a business school in London, a few VCs in Dubai and in Cape Town, and a lot of other things.
Great. Awesome. But he doesn't mean avatar in the metaverse sense, thank God. These are real life avatars.
Oh, that's coming back.
Well, apparently it is.
It is. Next year, 2024.
And if anybody wants to tune
Yeah.
in to one of the first episodes I actually did on the
Episode
Couchonomics
2
podcast,
or episode 3.
it was episode number 2.
Episode
You're right.
2,
It was
yeah.
episode 2, and we
Who
talked
got
about
number 1?
Roberto Crocci.
Ah,
He was
Okay.
with Microsoft at that time.
okay.
In any case, doesn't matter who
Anyways.
got number one, right? So we're in Singapore.
Yep.
We're at SFF.
Yep.
The overarching theme this time is re-architecting the world's financial system.
Yeah.
You can pretty much put anything under the
Yeah.
under the umbrella, and I think there is a good reason for that because
Yeah.
I think there is. I don't know if you coined it or someone else did in a conversation that we're living through an age of conundrum, right? And so there's so many trends, so
Yeah.
many catalysts, so
Yeah.
many innovations, some working contra to each other.
Yeah.
That this re-architecting of the world
Yeah.
will be an interesting one.
Yeah.
So unlike my usual episode, which runs in for 45 minutes,
Yeah.
we're going to try and do this for 15.
15.
I wanted to actually explore with you
Yes.
a statement that you made at a round table that we were on 3 days ago.
Yeah.
And it's not the first time I heard this statement. I heard this
Yeah.
statement about 5 years ago,
Okay.
right? Which is venture capital appropriate for digital banking? And digital banking is part of that re-architecting of the financial system, right?
Yeah.
Well, one could argue that every bank's eventually going to become a digital bank
Yeah.
if it hasn't already,
Yeah.
right? JP Morgan's budget, I think, far exceeds the next 100 fintechs or the top 500 fintechs. Can you dwell a little bit more on that
Yeah.
statement? Because we never got a chance to do that during the panel because I
Yeah.
think you said that at the very end of the 90 minutes.
Yeah.
So keen to hear your views. I have some thoughts on it too. So let's have a bit of a chat on that.
Yeah, sure. So there's two things you're saying. One is digital banks and what are they and who should fund them. And secondly, what is VC? And how does VC sit in this kind of funding ecosystem? And first, let's start with what is a digital bank. So how we understand digital banks are these financial institutions that were set up typically in the last 10 years. Most of them got banking licenses, such as the ones in the UK or in Brazil or in Hong Kong and Singapore. And they start as mobile internet native and usually cloud native, no branches or very few physical infrastructure, few physical presences. And they come with a balance sheet. And that's the key element. They come with a balance sheet. And that differentiates them from software companies. Software companies are balance sheet light. Digital banks, like traditional manufacturing companies or hardware companies, have balance sheet. Balance sheets require a lot of money, typically credit. Software companies can be funded with equity and venture equity. And venture equity has been around since the dawn of time, you could argue, but in an institutionalized way, really dates from the growth of Silicon Valley. It's not even an American thing. It's a West Coast, Palo Alto, Silicon Valley, San Francisco, California thing. And there are some specific features that go into creating that ecosystem. And that ecosystem invested in and made a lot of money backing some of the biggest companies in the world today, but they're all software companies. Now, VC doesn't just invest in software, but that's where a lot of the money has been made. A lot of the practices of VC and culture of VC comes out of that. And it's hard to apply that to banking. In fact, when you talk to some of the bank, founders, so say take an Ann Bowden at Starling, she's talked about this publicly many times. When she went out to raise funding, was it 2015 or thereabouts, most VCs in the UK and the US did not understand what she was trying to do. And the amount of capital she needed, they didn't want to put up. So she ended up getting funding from a billionaire. The digital banks here in this part of the world usually funded by either an incumbent bank, an FI, or a corporate, like often a big tech trying to go into financial services. So actually the empirical evidence of digital banks around the world is that they generally don't get funded by VCs. VCs do fund fintechs, but they're typically payment companies or software-like companies. So that's what I meant the other day when I said, is VC funding even appropriate for digital banking?
So it's very interesting, right? So so you said that.
Yeah.
My immediate reaction was to go back to my sort of, I guess my archive of various articles that I've either read or contributed towards, and actually
Yeah.
found something which is about 5 to 6 years old.
Yeah.
And the argument that we were trying to present, or a group of authors where
Yeah.
I had a bit of a contribution, was to say that VC capital is not correct for digital banking, and I mean the ones which are licensed
Yeah.
and with a balance sheet.
Yeah.
And the 5 reasons were as follows, right?
Yeah.
And not in any particular order. One is they are capital intensive,
Yep.
right? And not only capital intensive, there's a capital requirement from an adequacy perspective.
Yep.
So there's parked capital intensiveness, right?
Yeah.
Which is very different to a software company, right?
Yeah.
Software companies can be capital.
Yeah.
It's regulatory
Yeah.
capital, right? That was one. Secondly, typically the banking world, right, is heavily regulated, which
Very.
comes with its own inherent risk of the unknown, right? Depending on which angle does the risk go for. The third angle was, and at that time it wasn't proven so because I think a number of companies were on the high, but the multiples associated typically with banks were on the lower side. Now, at that time, digital banks were enjoying high multiples, but the whole point was that there will come a point of normalization. They will never be 3x or 4x of a normal bank, right?
Yeah.
They might be 2x, but still, compared to, as you said, software companies, it wouldn't be at the same multiple. And the last 2 points, I'm sorry to labor the point.
No.
One was scalability, and what I mean is cross-jurisdiction scalability is much harder, right?
Because going global is super hard.
Super hard, right?
Super hard, yeah.
Super hard. And the last one was everything to do with speed to return on investment.
Right.
And most VCs, if you read their, I guess their paper, those 4 or 5 points will be contra to what everything that the bank achieves, right?
Yeah.
And as a matter of fact, I'm actually going to dig that paper out and I'm going to represent it on my favorite channel, which is LinkedIn. I've obviously mentioned the fact that you triggered the thought back. Your thoughts on that? Is this aligned? Do you think there are things which have changed? Is there something else that we should be adding to that way of thinking around why VC capital is wrong?
Yeah, no, you mentioned a couple of good points there. One is the time horizon. In our previous discussion, I think several of us, including me at the roundtable, threw out this fact that only 5% roughly
make money.
Of the digital banks in the world make money. And that's just literally a positive return, not a positive return on cost of capital, like 10% plus, just make more than zero. And the pushback by a lot of the founders and CEOs around the table was, Ronit, we need time.
Yeah, so not enough water has flown under the bridge, right?
And some of the really successful digital banks in the world, like the Nubanks and the Tinkoffs, it took a long time for the likes of Nubank. Not Tinkoff, interesting enough.
But I think Tinkoff set themselves up as a credit business from day one.
Yeah. As did Nubank. I mean, they were a credit card company, obviously next generation. So the time horizon is typically 5-7 years plus for these digital banks to even break even. The VC is typically looking at investing and exiting in that kind of time horizon. It can be a bit longer, but a typical fund is supposed to be 7, 10, 12 years, right? So the time horizons are tight. They don't really fit. They barely fit in. And that last couple of points you mentioned about regulatory capital and scalability, it takes a long time. So you need a license. It's hard to get a license. Large amounts of capital usually go behind a license. And so if you're an early stage investor, say typically a seed or Series A investor, the size of check you're writing is simply not big enough usually to fund these companies. And you also have the valuation point super, super relevant. There's an old, it's not my saying, you always, like magpies that we both are, you have to recycle. Steal is a hard word, but recycle what you hear. And I remember this was in the last cycle, or the one before. I was sitting with a hedge fund investor in San Francisco, and he said, I'm shorting all these fintechs that have been listed. And I said, why? He goes, Ronit, in a bull market, fintech is tech. And we're in a bear market. In a bear market, fintech is fin. So the valuation multiples of fin and tech are very different. Tech typically gets valued at a multiple of revenues or cash flow or even adjusted EBITDA. What is adjusted EBITDA for a bank? Bank gets valued on dividends, net profit, return on equity, return on capital. So the multiples are at completely opposite ends of the spectrum. So this is what happened 2 years ago. Most of fintechs, including some balance sheet fintechs, were being valued as tech. And the founders were obviously, being thrown capital at them. People saying, some of the biggest investors in the world who are much richer and more successful than the two of us were saying, well, more than me, they were being told, spend, so you're not spending enough. Traction, growth, top line. Within a year or 18 months of interest rates going up, founders were being told, you need to make money. I need to see an ROI, an ROIC, and that's a really hard pivot to do in a short time period. So there's this whole valuation conundrum, definitely a conundrum.
So where do digital banks go then? What's the ideal sort of route or avenue that they should be going out to raise venture capital or early stage capital? Let's not call it venture, but let's call it early stage capital.
And we're seeing this in our adopted home region. You spend a lot of time in Saudi, I know, and in the UAE where we both live, and and I don't know how much of this is public, so let's not air this in the podcast, but we know what the budgets are for these digital banks. Those are, if not 100x, definitely dozens of x, a typical startup check from a Series A investor, a seed investor. Just the size of investment needed it's actually close to 100x.
So you go to sovereigns then?
Yeah. Or you go to a corporate or a existing, like we have here in Singapore, a very successful digital bank by numbers of clients, funded by and backed by one large old bank that's trying to reinvent itself and one retailer. And they back it. And so you go to sovereigns, you go to people with long-term capital, with long-term horizons, and maybe a strategic as well as a financial return goal, because the idea is that this becomes the future. It's like, it's not just a standalone project. It's a project where you can learn and then take the learnings back into the existing bank or the financial system at large.
So is this sort of I won't call it the Renaissance, but it's the second coming of the digital attackers, right?
Flanker brands, digital,
Because the initial sort of digital attackers didn't really work. And I personally think...
Which ones are you thinking about? Which generation or which type of banks?
So, the NatWest Bank or Bo or whatever. Royal Bank. I don't know which it was.
Bo was RBS now.
RBS. So there's been there. I think we have a couple in our region, which were created as so-called digital banks. But I think they were more digital front ends. They allowed them to reduce their cost to customer acquisition.
Well, they were like a different acquisition
channel. channel.
channel.
But then their expectation was that the products would be different, and the reality was that the product stack was not, and
Yeah.
the way they were underwritten
Yeah.
was very similar.
Yeah.
So while they kind of benefited on one side of the angle, they were never able to carve themselves out as
Yeah.
a full-on digital attacker. But what you're actually talking about is, and I think I think you might be talking about, for example, Trust Bank, which is the Standard Chartered NTUC partnership.
I wasn't
right?
going to give them the plug, but you have.
No, but it's
No, you're talking about,
interesting.
we're talking about
It's,
trust.
yeah,
Yeah,
exactly.
we're talking about
It is
trust
a
bank.
quite,
Yeah.
yeah. So to me, that is
Yeah.
the second coming of a digital attacker in a very different way.
Yeah.
They're not necessarily tied to uh, the umbilical cord is not there. There is an association which comes through possibly equity investments, right?
Yeah.
Some level of professional or management mentoring, but they're not riding over some part of the bank's system.
So, yes and no.
Okay.
So the ones we're thinking about, at least in the past, in our part of the world, in the UAE, sat on the same tech stack as the main bank, and that was true of many of these digital brands or distribution channels. The tech stack, the back end is the same. In many of the digital banks in Hong Kong and Singapore, the tech stack is different. The same happened in Israel with one or two startup banks set up by incumbents. The incumbents saw it as an opportunity to experiment, try something at a smaller scale. Same's happening in the UK with a very large US bank that's expanding in the UK. They're using a different technology stack partly. But there's still an existing, if you have a majority or a large stake in the new bank, your governance, your compliance rules, your risk rules do read across.
Okay.
And that, if you talk to any, at least off the record, to any senior manager or founder or CEO in these companies, is a challenge. Because you have all of the, not legacy tech, but the legacy
thinking,
governance
governance,
mindset. And that is a challenge.
That is a challenge.
It's a big challenge. The other one is, and this partly explains the problem of very large initial investments in cost base relative to other non-digital bank fintech startups, is that banks, partly due to their own governance and culture, but partly due to regulation, gold plate everything. And I mean like multiple layers. So the whole kind of just throw things at the wall, move
Attitude.
fast, fail fast, that doesn't work when you're a regulated bank. It kind of works if you're a fintech, a non-bank fintech. And that adds to huge extra costs upfront because you kind of gold plate everything. You can't just do like, I'm going to have a little, I don't know.
Okay, so let me,
Yeah.
it's just a thought which
Yeah.
crossed my mind, right? But we also talked a lot about trust.
Yeah.
Right? And the fact of the matter
With a small t.
Yeah, exactly. Yeah, not big T. I don't know about trusts and big T in that sense. But small T, and I think
Yeah.
everybody across the table, and I think I also fundamentally agree, trusting, a cup of coffee out of Starbucks is different than trusting a bank where you're going to put your lifetime saving or take a big loan against your mortgage.
Oh yeah, poisoned by my coffee. That's pretty existential as well.
Well, I don't know which coffee companies you go to, but the ones I do, we don't get poisoned.
Yeah, okay.
But doesn't that sort of layer of governance also in some way work to the benefit of that trust?
Yeah.
Right? Because at the end of the day, the client that you're targeting, for them, the understanding of banking still comes from the textbook of what a bank is, which still is what banking was 100 years ago, or at least what banks stood for 100 years ago. I don't mean banking hasn't changed. I do believe that banks don't get enough credit for small innovations, right? They have made lots and lots of small innovations in a highly controlled environment.
Yeah.
But that was just a statement.
Okay.
I just want to ask you the last question.
Yes, one last one.
How does this play out as according to the way the think tank is thinking in terms of, when the dust settles, or if it ever does, in this sort of digital banking debate, what does it look like?
Yeah. I guess the short answer is we don't have enough time to answer that question. And the dust doesn't settle, right? The dust will carry on whirling away. And we all know some of the mega trends that'll keep it whirling away. Over the last 10, 15 years, the big trend has been the consumerization of everything. Because suddenly what happened in the last 15 years, the smartphone revolution, is that we had in our hands more user-friendly and sometimes better technology than we had at work. Now, that had never happened until the smartphone revolution at scale. So suddenly we'd go to the office and we'd be dealing with older technology, or we'd go to the office and deal with our bank who was giving us older technology than what we had with our phones. And now we've seen across financial services the consumerization. So classic one is corporate payments. I send a payment. It's most of the time on Swift. Boom, it's there within an hour, particularly if it's Singapore, Dubai, or Singapore, London, Singapore, New York. But not an insignificant amount of time, the payment just gets stuck somewhere because of compliance, AML, sanctions, and technology. And at that point, you don't know where the payment is. When I order a pizza at night or you're on Talabat or Deliveroo, we can track it.
Yeah.
It's in the kitchen, it's in the bike, the guy's outside your house trying to work out how to ring the doorbell, whatever. You can track it, the pizzification or the consumerization. We can't do that with financials. Most of the time when something goes wrong, you go to your bank and say, what's happened? They're looking at you like, I don't know.
Yeah.
So that's the past. Now going forward, the big trends are if you take re-architecting, which is the kind of original question. I guess we can't not talk about AI. AI and Gen AI is going to have a profound impact on everything we do, not just financial services, everything we do. In some ways, blockchain is not as transformative, but that will also have an impact. So there are all these things that are coming, including XR and the metaverse, all these things that are coming. And financial services, ultimately, my closing remark is, none of us wake up in the morning saying, I want to do a payment.
Yeah.
Right? We wake up in the morning
Not wanting to make a payment.
Yeah, no, we normally not wake up in the morning, or we wake up from our work in the evening going, I want a pizza and I need to pay for the pizza, or I'm flying to Singapore to host this podcast and other things. I need to pay for my flight or, my house. You know where I'm going.
Fair enough.
So a lot of payments are embedded. They're invisible, whichever one you say. So that's the future where it's the next generation of like the consumerization of finance. We want to do other things. Basically, banking and finance needs to get out of the way.
Yeah, so it needs to get more and more invisible.
Yeah.
So hold this thought, because we're not done with this conversation. There is a
part two.
There is a part two, and I'll prime you on what I'd really want to get in and get your views on it. Is what happens with wholesale and institutional banking in this whole digital banking context, right? But thanks for coming in. I think you have a flight to catch either later today or something more interesting to do than rather just be sitting on the yellow table. So thanks for coming in, Ronit.
Thank you for having me,
and we
Arjun.
will definitely have this
Always a
part two.
pleasure.
All right.
And
cheers.
I do have a flight to catch.
Cheers.
Thank you.
Bye.